What is good, everybody, and welcome to part 1 of our video series on core market structure. Before we even get into any of that, though, I gotta break down the market cycles themselves, because I don't think that you can even navigate the markets without understanding this first. This is literally the core of everything else that you guys are about to learn. If you guys don't understand this, nothing else will even matter. So the nuance behind some of this in the different asset classes are going to be a little confusing when you start off, but the more that you research, the more that you study, the more that you get into this space yourselves, the more it'll make sense to you. So with that being said, this is market cycles and smart money's compounding playground. Where do I begin? Let's start with the markdown phases. Now, within every single market cycle, you're going to see 4 different phases. We're going to start off with the markdown phase. This is when these big guys, these big whales, the people who control the markets, they start selling some of their positions, and the market starts to go down and down and down in a very steep decline, ultimately seeing an 87% sell-off from 2013 going into 2015. Now, this is the markdown phase because prices are literally being marked down. If you're at a supermarket, if you are at a sneaker store, you're going to try to find something that is worth value to you, but at a discount. It is the exact same things within the financial markets. The goal is to find the best value to make some money, or within real life on food or clothes or whatever it is, to save some money. So in this case, prices are being marked down. We'll get into all of this in a second, all of this compounding, but throughout this phase, prices is just selling off. The market doesn't just go up or down in a straight line, so they're selling periodically. Knowing when price bottoms out is a skill in and of itself, but that comes with understanding the nuance of every single financial market. After price has hit this shallow decline of 87%, we start trading sideways, and we do so in the form of an accumulation, which comes at the next phase. So the accumulation phase comes post markdown, and ultimately this is when these big guys have deemed the market to be extremely undervalued. We have now exhausted all of that selling pressure, and we are now going to buy. So what happens? We come and create these lows that never get visited again, and ultimately the pattern starts to form before those lows do. If you know, you know. Now, during this accumulation, price gets pushed out of here in the form of higher highs and higher lows. And this is where understanding the core market structure will be extremely important, because here is a lower low in comparison to these lows, but we didn't actually break the structure low. So we'll get into all of that in a couple of videos, but it's a very, very tricky game. And this is a wick, so technically it did not create a new low. Technically, because that is a wick. So the way that you look at the markets in these phases, it might confuse you. It is supposed to confuse you. They want every single share imaginable to control the price and push it evidently higher, 12,000% higher to be exact, as that comes with the markup phase. These big institutions, these big hedge funds, smart money as a whole, they want to turn you guys into the exit liquidity. And exit liquidity is simply when there's enough hype behind an asset like Bitcoin, any cryptocurrency, whatever it is, they can now sell their positions back to you and profit, because you think that you can now make money off of that asset, and you think it's going to continue to go up. Since they control the majority of the shares, a majority of the coins within the market, you guys are now buying all of those dips back periodically without knowing that asset is in the midst of a bear market or a markdown phase. And how that happens is through something called distribution. So after this markup of about 12,000%, which lasted 3 years from 2015 to 2018, we see our distribution phase. And that is when you see these little short patterns within the markets. You can even see them forming before they happen. Again, if you know, you know. Here's your liquidity sweep. Those are the lows. And you can see all of this stuff before it even happens. But this is the distribution phase now, where prices on these assets are slowly becoming overvalued, and now these market makers are taking profit. But they do so in the way of compounding. Now, I'm just going to show you one-to-one. This is not a realistic example. We will get into a realistic example in a couple of minutes, but I'm going to show you just the one-to-one of percentage gain and what compounding in every single market cycle can look like. So let's say in 2013, you wanted to buy BTC. You saw it was at $1,200 USD and you're like, okay, I'm going to buy one share. Let's say you saw the market take a steep decline in December of 2013. You're like, all right, let's not do it. It scared you away. You look at the markets a couple of months later and you're like, hey, we're down 87% from when I was going to buy at. And you're like, let's pick some up. So you go and buy $1,200 worth of BTC at 100 and let's say 175, because I don't want to really count these lows one-to-one. So let's say you buy $1,200 worth, that's your capital, at $175 per coin times your next peak, which is what you see here in 2018 where you would take your profit, at $18,000 per coin, having an average of $175 per coin, you just made 122 grand. Now, let's say you take your profit there. You literally hit it perfectly. It's not realistic, but let's say you hit it perfectly. And you are ready for now this next markdown phase. If you had compounded from these lows, let's say, again, I'm giving it a little bit of spread because I don't want to do it like exactly one-to-one. So let's say your average now was $3,500 per coin. Let's say you had $122,000 in capital from here and you want to use all of it. You're a degenerate. You wanted to gamble it. You see crypto is notoriously bullish and you wanted to go all in. If you had sold at the $64,000 highs, you would have made $2.2 million off of a measly $1,200 in 2013. Now, again, this is not realistic. This might happen if you're trading meme coins. This might happen if you find an IPO'd stock that literally just IPO'd and it's shorted 80% plus. There's different ways to do this. You guys just have to know exactly what to look for, though. So it's not useless information of such high expectations when it comes to numbers, but don't expect it to happen every day. So the compound went from $1,200 to $2,200,000, which is exponential growth, but it's not done. This is why people love cryptocurrency so much. So price goes and marks down again, and ultimately, let's say you take your 2.2 million, and let's say you go and buy again at $18,000 per coin. Let's say 18,000. You had bought at these lows right here. At $100,000, which is where Bitcoin currently stands at, well, 99K, we literally were $200 away from 100 grand. You would have now turned $1,200 in capital in 2013 or 2015, I should say, to $12.2 million in the span of roughly 10 years. I'm not saying this is possible for the everyday person. You have to be extremely lucky to see anything close to this. But overall, it is possible. If you catch the right moves, if you do things at the right time, it is possible. And you never know. People always ask themselves, why me? Why me? Why me? Why not you? Why the fuck not? Why not you? Who knows? Who knows what can happen in your life? But anyway, let's go to an actual like real life example that I think is a lot more realistic, that has shown signs of stability. I'm going to switch to Apple. It's going to bring up a whole separate course that I was working on when it comes to order blocks and stuff. So we're going to switch the chart. Yeah, there you go, buddy. All of that. And we're going to switch the chart to Apple on this side to see the bigger picture of how all of this compounding works on a blue chip stock instead. Because we all know cryptocurrency is notoriously bullish. But what if we were able to incorporate this in the stock market? How would that look like? So stocks, cryptocurrency, they all move completely different. The stock market is not going to fall 80% plus on a 3-point-something trillion dollar market cap asset like Apple. It just won't. Recessions are the only exception. Depressions are also another exception. But overall, you start seeing a trend on Apple. This is the dot-com bubble. Apple sorted 80% plus. This is never happening again on a stock like Apple. Let's get that out the way from now. This is Apple's very early days of innovation, so we can give that the benefit of the doubt. This was still one big range, and here's where I'm sort of getting a little bit more into market structure, but this is still the beginning stages of one huge range. Now, what happens next is very, very mind-blowing that people don't necessarily even look at. Market cycles last roughly 2 years, and they start after the markdown phase is done. right? So notice here, markdown phase done from 08 to, or sorry, 07 to 09. And what happened from 09 to 2012? This was about 3 years. When was this exactly? When did we bottom out? February 09 to September of 2012. So let's say 2.5 years this was. From here to here, right? And then you see your first big short, which is, I'm going to guess 40%, because I already did this. So 46% we shorted, right? Within the span of 2 years after a huge long. So markup phase complete. Here's your markup. And now you've entered the markdown. Now we go on markup again. But would you look at that? This is still another 2 years from 2013 to 2015. So now you're sort of recognizing the trend. And we short another 30% plus. From here to here, 2016, which is when we bottomed out, to 2018. Would you look at that? Another 2 years. And I'm going to save you guys the time, as this just continues to happen every 2 years on Apple, where we short 30% plus. 30%. COVID. 30%. COVID was in 2020. Apple's next pullback was in 2022. And lo and behold, 30%. So when you understand the market cycles like this, when you understand how liquidity looks, when you understand all of this, that is when you guys, at least in my opinion, can become a profitable trader, profitable investor, a profitable analyst. The goal here is to understand the nuances of all of the market structure itself, but also to understand which part of the cycle that you are currently in. Understanding when an asset is undervalued, understand when an asset is overvalued, understanding how to use different tactics and tricks and Fibonacci levels and indicators to make some money. But overall, this video was supposed to act as a general idea of how market cycles worked. There's still a whole lot of other stuff that I want to put out through text that I don't think I can put out through one large video form. So overall, I'm going to be using this this lesson to just continue to add more content in here. So hopefully you guys did find some value in how market cycles work. If your name is Michael, congrats for the shout out in this video. But overall, you guys have a general idea of how market cycles work. Anyway, guys, take care, and I will see you guys in the next video.